on this nice, bright, sunshiny day. Without objection, the chair may declare a recess at any time. I recognize myself for the purpose of making an opening statement. Banks fail. That's a fact. But on March 10th, Silicon Valley Bank failed nearly overnight. The speed that it failed raised immediate concerns not only of poor management at the bank, but of a failure of oversight as well. Evidence that has surfaced since then has shown exactly that. Absolutely, there was incompetence at the top of the bank. Management, the board, they all failed. But the people we have entrusted and empowered to protect the taxpayer and our financial system had as much to do with Silicon Valley Bank's failure as the bankers themselves. Even the Federal Reserve has publicly taken some blame. In my first few years in Washington, one thing has been clear. Government agencies aren't good at taking accountability for their failures. And I always say this, we can't fix a problem that we first can't admit that there is a problem. When crises and failures happen, there's always a lot more to the story, and everyone's got one. Silicon Valley Bank was the second largest bank failure in U.S. history. I want to just make note, second largest bank failure in U.S. history. So you might expect the causes were complicated. But in fact, it was one of the least complicated bank failures in history. The bank was invested in some of the safest securities available, U.S. Treasuries and agency securities. The credit risk, minimal. The only real risk to these securities was high inflation risk. Then came the rampant inflation brought on by President Biden's unnecessary spending, injecting trillions upon trillions into an economy already flush with cash. In response, the Fed spent months tightening to try and extinguish the rampant inflation. Instead of mitigating the risk of rising inflation by hedging with other financial tools, Silicon Valley Bank did nothing despite knowing these risks. Now we're forced to be hedged by the regulators. Despite knowing that most of Silicon Valley's bank deposits were in excess of $250,000 of the insured deposit limit, anyone could see that the ingredients for a run on the bank were in place. Regulators should have seen it coming from a mile away. At the end of the day, that is their job, to regulate. The combination of an unstable deposit base and a plummeting bond portfolio contributed to the evaporation of the $212 billion bank nearly overnight. All of these raise serious questions. Who was overseeing the bank? And I want to emphasize on who was overseeing this bank. What were they focused on instead of risk management? So what were they taking a look at? Their job was the management of risk at that bank. Clearly they weren't doing that. What else were they focused on? And why didn't they intervene? Did regulators get complacent and buy into the political narrative that Dodd-Frank solved all the problems? If so, I would argue if they bought into that narrative, why do we need regulation upon regulation and regulator and agency upon agency? Were the regulators communicating clearly with the bank managers on matters that needed addressing? Or did regulators flood management with process questions instead of focusing on the fundamental issues that mattered? Today, we're going to try and get some answers on where and why regulatory supervision failed. But we are not stopping there. We are going to take a deeper look into the steps regulators took in recent years, asking questions. Did the Fed use all the tools available to prevent this failure? Did the Federal Deposit Insurance Corporation, or FDIC, have the proper early warning signs systems in place? Has the FDIC been transparent about the process around the seizure of the Silicon Valley Bank? Or is there more to the story? Did the Fed's post-moratorium evaluation pursue a political objective, or was it truly a self-reflective exercise to uncover the truth? This committee is named Oversight and Accountability, and that is exactly what we are pursuing. If government officials are to blame and have not been forthcoming, we will hold them accountable. I am pleased to introduce our witnesses who are here to discuss the Federal Reserve's oversight of bank risk management amid recent bank failures. Mr. Michael Clements is the Director of the Financial Markets and Community Investment Team at Government Accountability Office.
Recognize the ranking member.
Oh, my heavenly days, my bad. My story got away from me, Miss Porter. See, my bad. I now recognize my dear friend, Ranking Member Porter, for her opening statement.
Thank you very much, Chairwoman McLean. Anyone who knows my style knows that I love hearings. Hearings let Congress hold powerful people accountable. They let us secure commitments from important officials, and most importantly, they let us get to the heart of problems so that we can write good legislation. As much as I love hearings, I don't love Congress holding hearings on the same things year after year because we keep making the same mistakes. I wish that I could say this is Congress's first hearing to dig into the causes of bank failure. It's not. That's because when it comes to regulating our banks, Congress has a short-term memory on what works and what doesn't. The lessons from events like the 2008 financial crisis shouldn't be hard to remember. Bank stability happens when we have strong, clear rules in place, and bank failures increase when we take these rules away. Unfortunately, Congress just isn't learning. Let me tell you how things work around here instead. Every so often, our country has a bank failure. If just enough legislators decide to grow a spine or find some other part of their anatomy, Congress passes legislation to more effectively regulate our banks. It starts to work, and we all start to get comfortable. Then the bank lobbyists come around Capitol Hill, and they ask members of both parties to deregulate. Democrats and Republicans get convinced that a little bit of deregulation is an easy way to appear pro-business. Why not ease a few regulations? What these members of Congress seem to forget is that there is nothing pro-business about a bank failure. But if history is any lesson, the bank failure is coming when we take away the rules that keep the banks in check. And just as predictably, when that bank failure comes, the government will swoop in to save the financial system, and members of Congress will yell about how terrible the failure is. You'd think that would spark re-regulation. Not necessarily. The problem is that the members of Congress who are loudest about the failure are often the ones most terrified of legislating to address it. After the failure of Silicon Valley Bank, I introduced two bills. One reverses the most damaging regulatory rollbacks from the last time Congress listened to lobbyists. The other bipartisan bill claws back unjust compensation from bank executives when their bank fails. To be sure, I have had great partners on both sides of the aisle. But what I've noticed is the voices here in Congress that spoke the loudest about how terrible bank failures all of a sudden then urge caution about considering legislation. They say, we need time to look at all the facts before we act. What's there to look at? The problem is that we repeatedly regulate, then deregulate, and then take too much time deciding whether to re-regulate. Along the way, it's the members who get taken in by lobbyists or who are too afraid to act that get us trapped in this vicious cycle. There is a better way. Let's keep rules in place that help us have a stable and growing economy. Every fellow capitalist in this room should want that. We should all want to address the issues outlined in the Federal Reserve's report on the failure of Silicon Valley Bank. If you have not read this report yourself, I encourage you to. Unsurprisingly, this report calls out S2155, the big 2018 bank deregulatory bill, as one of the key causes of the Silicon Valley bank failures. They say it reduced supervisory standards. I bet you won't hear a ton of Republicans or Democrats who supported 2155 admitting that today. But at the same time, Republicans will make a very important point today. Bank failures don't only come down to the rules we put in place, they also come down to the watchdogs who we have to enforce those rules. And the Federal Reserve's report also called out failures of Silicon Valley Bank's management and the bank supervisors who oversaw them. It's not anyone's job to defend the Fed today, and I sure as heck won't be doing it. We have to take their failures just as seriously as we take deregulation. All in all, we need to let this year's bank failures be our last hard lesson. From the regulations to the regulators, we can't let anyone off the hook for the vicious cycle in our banking system. I yield back.
Thank you, Ms. Porter. I'm now pleased to introduce the witnesses who are here to discuss the Federal Reserve's oversight of bank risk management amid the recent bank failures. Mr. Michael Clements is a director in the Financial Markets and Community Investment Team at the Government of Accountability Office, GAO. In this position, he's led the GAO's work overseeing and regulation of financial institutions and markets. Welcome. Mr. Jeremy Newell is a senior fellow at the Bank Policy Institute and the founder and principal of Newell Law Office. He is a recognized expert in banking law and financial services regulatory policy matters. Welcome. And Ms. Catherine Judge is Harvey J. Goldschmidt Professor of Law and Vice Dean for Intellectual Life at Columbia Law School. She is an expert on banking, financial innovation, financial crisis, and regulatory architecture. Welcome. Pursuant to Committee Rule 9, the witnesses will please stand and raise their right hand. Do you solemnly swear or affirm that the testimony that you are about to give is the truth, the whole truth, and nothing but the truth, so help you God? Let the record show that the witnesses all have answered in the affirmative. Thank you. We appreciate all of you being here today and look forward to your testimony. Let me remind the witnesses that we have read your written statements and they will appear in full in the hearing record. Please limit your oral statements to 5 minutes. As a reminder, please press the button on the microphone in front of you so that it is on and the members can hear you. When you begin to speak, the light in front of you will turn green. After 4 minutes, the light will turn yellow. When the red light comes up, your 5 minutes have expired, and we would ask you to please wrap it up. I will now recognize the first witness, Mr. Clements, for 5 minutes for your opening statement.
Chairwoman McLean, Ranking Member Porter, members of the subcommittee, I am pleased to be here today to discuss GAO's preliminary work on the March 2023 bank failures as reflected in our April 28 report. At the time of their failure, Silicon Valley Bank, or SVB, and Signature Bank were the 16th and 29th largest banks, respectively, in the country. Their failures could impose a $22 billion cost on the Deposit Insurance Fund. While not part of our work, First Republic's recent bank failures could impose another $13 billion cost on the fund. For today's hearing, I will focus on one bank-specific failures that contributed to the failures, and two supervisory actions regulators took leading up to the failures, with a focus on SVB and the Federal Reserve's supervision. First, the bank's failures. We found that risky business strategies and weak liquidity and risk management contributed to the failures of SVB and Signature Bank. SVB and Signature both experienced rapid growth, far exceeding a group of 19 peer banks. For example, SVB's assets more than tripled in the 3 years prior to its failure. SVB and Signature also relied heavily on uninsured deposits, which are prone to run risk. SVB funded 80% of its assets with uninsured deposits. SVB and Signature also exhibited weak liquidity and risk management. When confronted with external pressures, in the case of SVB, rising interest rates, the risky business strategies combined with weak liquidity and risk management controls contributed to the bank's failure. Second, the regulators' supervisory actions. We found that the regulators identified problems at both SVB and Signature Bank, but the regulators did not escalate their supervisory actions in time to mitigate the risk. Federal Reserve staff who supervised SVB identified problems at the bank. Between 2018 and 2022, the Fed issued 10 matters requiring attention to SVB for liquidity and risk management problems. For example, the Fed found that despite liquidity appearing strong, funding sources were concentrated and potentially volatile on short notice. However, we found the Fed did not adequately escalate its supervisory actions. The Federal Reserve was generally positive of SVB from 2018 through June 2022, rating SVB's overall condition as satisfactory. Despite the MRAs, the Fed assigned the highest ratings to SVB's liquidity and second highest ratings to its management. Staff also accepted SVB's planned actions to address the problems. When SVB moved to the Federal Reserve's regional banking organization from its large and foreign banking organization, examiners did begin downgrades. Yet despite the consistent and serious liquidity and management problems, the Fed did not issue an enforcement action before the bank failed. While the Fed began a memorandum of understanding in August 2022, it kept the MOU open. It did not complete the MOU before SVB failed. GEO has reported similar findings in the past. In 2015, we reported that although regulators often identified risky practices, the regulatory process was not always effective or timely in correcting the underlying problems before banks failed. In 2011, following the financial crisis, we recommended that regulators consider non-capital triggers to their prompt corrective action framework to help give more advanced warning of deteriorating conditions. And in 1991, following the savings and loan crisis, we found that regulators did not always use the most forceful actions available to them to correct unsafe and unsound practices. We continue to believe that taking early actions would give regulators and banks time to address deteriorating conditions. Chairwoman McLean, Ranking Member Porter, members of the subcommittee, this completes my prepared statement. I would be pleased to respond to any questions you may have. Thank you.
Thank you, Mr. Clements. The chair now recognizes Mr. Newell for his opening statement.
Thank you. Chairwoman McLean, Ranking Member Porter, and members of the subcommittee, thanks for the opportunity to be here today. This hearing presents a rare opportunity to examine an activity that is important and consequential, but almost always occurs in secret: bank supervision. Because banks play such a crucial role in supporting businesses and consumers and enjoy the privilege of federal deposit insurance, they are subject to an arrangement that is quite unique within our federal administrative state. They're subject not only to statutes, rules, and law enforcement, but also to a standing workforce of federal employees whose principal job it is to examine whether they operate in a manner that's safe, sound, and compliant with law. These examiners play an important role. While ultimately it is up to bankers to properly manage their own banks, and it is not the job of supervisors to prevent every bank from failing, good supervision enables the banking agencies to identify and seek correction of unsafe and unsound practices before they lead to a bank's failure. Reflecting that goal, the best bank supervision is supervision that's grounded in clear rules, focused on material risks that might lead to a bank's failure, and informed by an independent view of risk among examiners. When supervision is effective, it generally succeeds quietly. When it's not, its failures are public, often spectacularly so. Today, you consider such a latter case. While responsibility for Silicon Valley Bank's failure rests first and foremost with its management, understanding where the Fed's supervision of SVB may have gone wrong is a rare and important chance to publicly assess the Fed's supervisory practices and identify potential future improvements. We are aided in this regard by the initial reports prepared both by the GAO and the Fed concerning how SVB was supervised, and by the Fed's release of some, though certainly not all, of the relevant supervisory materials. While these are helpful first steps, much more is needed if we're going to gain a definitive view of whether SVB was supervised appropriately and to understand how best to improve supervision in the future. Simply put, we don't have a full picture, as what the Fed has provided to date is both selective and incomplete. Further analysis is especially important because what information the Fed has made public suggests several serious problems in supervision worth greater scrutiny. The Fed report concludes that examiners didn't fully appreciate SVB's weaknesses and didn't take sufficient steps to demand that they be fixed, but cast blame for those failures on decisions made by former Fed leaders that it alleges reduced standards, increased complexity, and promoted a less assertive supervisory approach. The underlying evidence suggests strongly that that's the wrong diagnosis. Rather, that evidence paints a different picture, one in which supervisors were principally focused on the wrong issues, occupied with processes rather than material risks, and were plenty assertive, just not about the risks that proved to be SVB's downfall. I would offer three particular observations here. First, supervision of SVB was heavily focused on compliance processes and governance, and not on material risk to SVB's financial integrity. There was no shortage of intense supervisory activity around SVB, but much of it, nearly all of it in fact, reflected concerns over processes and policies that may have distracted examiners from focusing on the serious risks building on SVB's balance sheet over time. Second, examiners largely relied on a system of issuing examiner directives, so-called matters requiring attention or MRAs, that themselves were not appropriately directed at SVB's growing financial risks. Perhaps the best example of this is to consider the 31 supervisory directives that were outstanding at SVB when it failed. Of those 31, only a small portion related to the liquidity and interest rate risk problems that led to SVB's failure, and even that small portion was largely directed at risk processes and not actual risk exposures. Third, supervisors failed to enforce important enhanced prudential standards in the areas of liquidity and risk management that were applicable to SVB, even though they understood SVB was not meeting them. This fact, I think, is especially important because it demonstrates that SVB is a case of failed supervision, not failed regulation. While some, including the Fed, have suggested that changes to the rules applicable to SVB in 2018 and 19 were responsible for its failure, I believe the evidence points the other way. Those changes, in fact, left in place liquidity stress testing and risk management requirement that went to the core of SVB's problems and which SVB apparently did not comply with, yet on which examiners did not act. This suggests that the rules were fit for purpose. It's supervision that was not. Taken together, the picture that we have today strongly suggests that the Fed's supervision of SVB may reflect a larger culture of bank supervision that has increasingly lost its way and become distracted from its core mission of scrutinizing bank safety and soundness. It also suggests that the reforms that are needed don't simply involve tougher supervision or more rules, but instead broader structural reforms to the supervisory approach that allow examiners to better direct their attention and considerable supervisory tools to the kinds of core safety and soundness risks that led to SVB's demise. Thank you, and I look forward to your questions.
Thank you, Mr. Newell. Now, the chair now recognizes Ms. Judd for 5 minutes. Ms.
Chairwoman McLean, Ranking Member Porter, and members of the subcommittee, thank you for the opportunity to be here today. On April 13th, 2012, JP Morgan CEO Jamie Dimon was asked about reports that the bank's chief investment office may be facing significant losses because of bets it made using credit derivatives. Dimon downplayed the concerns, describing the bank as conservative and the situation as a complete tempest in the teapot. That supposedly teapot-sized tempest ultimately cost JP Morgan more than $6 billion and inspired the Senate Permanent Subcommittee on Investigations, under the leadership of Chairman Senator Levin and Ranking Member Senator McCain, to examine just what had gone wrong inside the bank and why the OCC, the bank's primary supervisor, had not done more to prevent the losses. The bipartisan report exposed significant deficiencies internal to JP Morgan Chase. It revealed that internal risk limits had been breached more than 300 times, and that the bank had changed how it calculated certain risk limits rather than addressing the underlying problem. The report showed Chase had mischaracterized the portfolio producing the losses as a risk mitigating hedge when it was not. And it further showed that Chase had dodged regulatory oversight by omitting data in its reports to the OCC and failing to respond appropriately to information requests. The report also found meaningful shortcomings at the OCC's supervision of the bank. It revealed patterns of inconsistent and insufficiently robust follow-up when problems were flagged, and it further revealed that supervisors were often too hesitant to challenge the bank. Yet the report recognized that the primary responsibility for the losses lie with JP Morgan. This is just one of many examples of Congress usefully using its oversight authority to hold banks, bank executives, and bank supervisors accountable. Following the 2008 financial crisis, the Permanent Investigation Subcommittee also undertook a deep bipartisan dive into the causes of the crisis. The final report showed how high-risk lending by banks, inflated credit ratings, investment bank abuses, and a troubling tendency by the Office of Thrift Supervision to treat banks as its clients had contributed to the crisis that caused so many to suffer. After the stock market crash of 1929, the Senate Banking and Currency Committee launched an investigation into the securities industry. With Ferdinand Pecora as lead counsel, and the hearings and report provided valuable insights into troubling Wall Street practices, from undisclosed loans to senior officers, to conflicts of interest between commercial banks and their affiliated securities dealers. Following the 1907 financial panic, the House Committee on Banking and Currency under Congressman Pujo undertook an extensive investigation of the ways financial and economic power had grown more concentrated in the hands of JP Morgan and a small network of other Wall Street firms. In revealing troubling practices by large financial firms and showing how often other people suffer, these reports help to spur legislative and regulatory change. The Pujo hearings contributed to the adoption of the Clayton Antitrust Act of 1914 and the creation of the FTC. The Pecora hearings helped to motivate and inform the Securities Act of 1933, the Exchange Act of 1934, ushering in a new era of investor protection. The Levin-McCain report and the Levin-Coburn report helped motivate robust implementation of the reforms mandated by Dodd-Frank and served as a powerful reminder of the need for ongoing diligence in the regulation and oversight of the financial industry. In short, Congress has an illustrious history of using its oversight authority to expose troubling behavior and bringing about needed reforms. This has been enabled in part by asking the right questions and learning the right lessons. Shortcomings in bank supervision at 4 different supervisor bodies played a meaningful role contributing to the recent bank failures. As the GAO and other reports make plain, many of these shortcomings are not new. Recent events should spur a close examination of how to encourage bank supervisors to ask hard questions, spot troubles in a timely way, and follow through with diligence and rigor. In my written remarks, I explore how to use escalation frameworks and other tools to enhance both bank supervision and oversight of bank supervisors. Yet the success of supervision depends not only on how well supervisors do their job, but also on the magnitude of the task set before them. Strengthening the regulations governing large regional banks is the most important step Congress and regulators can take to make the supervisory task manageable. Limiting the ability of bank executives to walk away well compensated for running their banks into the ground is also important. Bank supervision is a critical component of bank oversight, and it's most likely to go well when supervisors are set up for success. I look forward to your questions.
Thank you, Ms. Judge. I now recognize myself for 5 minutes. What I think is important here is there's already been a lot of reporting about what brought down Silicon Valley Bank. But really what I want to focus on is how the regulators were complicit in helping this to happen. See, we have a certain set of rules out there for private business, right? Heads roll, people get fired, stock prices go down, and that ugly word profit goes down as well. There is a consequence to one's actions, as there should be. However, I am amazed in my short 2.5 years here in Congress to see we have government agency on top of government regulation agency with regulator upon regulator with more regulation than we know what to do with. Whose head's gonna roll? Whoever gets fired. What's the consequence to the action? And I think that's what I think we need to focus on. We don't need to have more law, then rescind it, then have more law, then rescind it. We need to first start with, we have laws on the books. We have regulators who are supposed to enforce those laws. They need to do their job and enforce the laws that are on the books before we even consider giving them more power, more money, period. So with that said, Mr. Newell, I'd like to start with you. Is there more the Fed could have done to prevent this failure from happening?
Certainly, and I unfortunately maybe caveat my remarks with, I can only give you a tentative answer to that question because you have to answer it based on the public record, which is to say the information that the Fed has released so far. And although certainly there's a lot of useful information in that preliminary Federal Reserve report and some useful supervisory materials that they have provided, you certainly don't get a complete picture, and I'm happy to talk a little bit more about how you might close some of those gaps. With that said, to the extent that we do have public information, one of the things I think that you see kind of consistently throughout the process, as I noted in my opening remarks, again, is a focus on process and risk controls rather than actual risks that were accrued.
Can you give us a specific example?
Certainly. So, again, I think if you step back, for example, the perfect picture is painted by the 31 supervisory directives that were outstanding when Silicon Valley Bank failed. If you look at those 31, 6 had to do with liquidity, which was a major problem in SVB's failure. 1 had to do with interest rate risk, which was probably the single most important cause. And the rest were other areas. For example, 13 of them dealt with information technology. If you dig in further, for example, look at those 6 liquidity MRAs that existed at that time. Again, most of them deal with processes, call for project plans, various controls. None of them go to the sort of the core key question of, do you have enough liquidity? And so again, I think that's a useful example. Another also on the question of liquidity, the Fed report reveals that after the Fed issued those supervisory directives on liquidity, I believe late 2021, it was pretty quickly revealed in 2022 that SVB was running internal liquidity stress tests, which were required under the Federal Reserve's rules, which showed that they didn't have the buffer of liquid assets they needed to survive a 30-day period of stress. That's not something that the Fed ever followed up on, issued an MRA or MRIA. Instead, the Fed report admits they didn't do that because they were focused on remediation of the sort of the more procedural MRAs that were issued on liquidity earlier the prior year.
Thank you. Mr. Clements, were there actions regulators could have taken prior to these failures, and what would you change to keep this from happening again?
Yes, I would say our work has shown, both for these 2023 failures as well as earlier ones, that there needs to be more timely and forceful actions when problems arise. Having policies and processes are good. Those are internal controls to prevent risk from arising, but once the risk has arisen, we need forceful action. We have recommended on multiple occasions that there be some type of trigger mechanism, that if the bank passed some trigger, that action would be taken rather than simply allowing the problem to persist.
And you said earlier in your opening statement that they did not escalate the concerns. Why do you think that was the case?
There's been a variety of instances that we've reported on that regulators favor an informal, collaborative approach, which we don't necessarily disagree with, but at some point you need to take action. Sometimes it's challenging when a bank is profitable and has adequate
That's their
capital.
job, correct?
It is their job, but it is challenging when the bank's profitable.
I don't want to take up too much of my time. Thank you, sir. The chair now recognizes Ranking Member Porter for 5 minutes.
There's no question that Congress bowed to political pressure and pursued a deregulatory agenda when it passed Dodd-Frank rollbacks in 2018. Congress put profits over people. What we hear a lot less about is how the Federal Reserve also helped push us off the cliff by deregulating. In fact, in my maybe 3rd hearing in Congress in the early spring of 2019, I asked Chairman Jerome Powell about the weakening of the capital, liquidity, risk requirements, and he claimed that there, in fact, was no weakening of those requirements, which I found interesting given that the Federal Reserve's report about Silicon Valley Bank takes ownership at the Federal Reserve for, in fact, having weakened those very regulatory requirements. But unfortunately, Chairman Powell isn't here today for me to ask him about his testimony. So I want to talk about how the Federal Reserve did, in fact, deregulate despite what Mr. Powell told this Congress, and what the consequences of that are. So let's look at what motivates the Federal Reserve's regulatory decisions. Federal Reserve is an independent body. Ms. Judge, who does the Federal Reserve work for? The banks it regulates or the American people?
The American people.
So the Federal Reserve has a duty to the American people. Let's look at what that duty is. Is that duty to provide a stable financial system, or is that duty to maximize bank profits?
To provide a stable financial system.
Great, we agree. So let's see what the Federal Reserve has been up to in meeting its duty to the American people to provide a stable financial system. Under Chairman Powell, as acknowledged, not by him, but by the Federal Reserve's report about Silicon Valley Bank's failures, the Federal Reserve relaxed banks' capital and liquidity standards. For example, removing the liquidity coverage ratio that would have applied. Ms. Judge, how did this change make the banking system more stable?
It did not.
And Ms. Judge, how would that have changed, this deregulation have changed banks' profits?
It would have allowed them to be more profitable, and it also enabled them to grow quite quickly without being subject to the enhanced prudential standards that would have been appropriate in light of that growth.
It doesn't sound like this change was aimed at creating a more stable financial system. Sounds like it was maybe more geared at maximizing bank profits. Let's try something else. In 2019, the Federal Reserve made it easier for banks to pass stress tests that assess their resiliency. For example, moving from monthly stress tests to annual ones. Ms. Judge, how did this change make the banking system more stable?
It did not.
How did that change affect bank profits?
It probably reduced their costs and increased their profits.
Yikes. Bank profits win again. But we agree, the Fed's obligation is to the American people, not to banks. But here we are, banks 2, American people 0, with regard to the Fed's behavior. Let's try one more. The Federal Reserve signed off on mergers by large super-regional banks. Ms. Judge, how did this change make the banking system more stable?
It did not.
And how did that change affect the acquiring bank's profits?
It boosted those profits.
3 in a row, or should I say 3 strikes and you're out. Whether it's intentional or not, the Federal Reserve has a pattern here of prioritizing banks' profits. If the Federal Reserve consistently prioritizes banks' profits over the stability of the banking system, if that's in fact what they do, who does it seem like they're working for? The banks or the American people?
It does not make it appear that they are working for the American people.
Sounds like Congress is not the only entity bowing to pressure from big banks. Until the Federal Reserve and Congress truly work for the American people, the stability of the banking system won't be the priority. I yield back.
Thank you, Ranking Member Porter. The chair now recognizes Ms. Fox for 5 minutes.
Thank you, Madam Chair. And I want to associate myself with the remarks the chairwoman made at the beginning about the need to hold people responsible for regulations. And Mr. Newell, you said the regulators were focused on process. Well, I'm not in favor of adding new regulations because I think that's a waste of time and money. But is there anything that can be done to get the regulators to stop focusing on process and start looking at deficiencies, non-compliance, and other risks in a bank's operations so we stop the failures that are occurring?
Certainly, Congresswoman. I think, again, first and foremost, what would be useful here is a general and more structural change to the way that the banking agencies, including the Federal Reserve, approach supervision. Again, I think small changes are probably not ultimately going to suffice. It's going to require some deep thinking and a much broader change in terms of the culture of supervision and the overall program of supervision. Again, that ultimately, results in very clear direction to examiners that although certainly processes and procedures can be important, especially in the area of risk management, because they're what ultimately gives rise to the risks that matter most.
Okay, well, let me interrupt you there. So it's not our job to put out those instructions to them. Should we say to this Federal Reserve, write the instructions and hold your bank examiners accountable and give us a report on whether they're being held accountable?
Yes, I think certainly that would be a constructive step. Again, I think there's relatively limited articulation at the regulators, in terms of what their overall supervisory, objectives are and what their directives to examiners are. So certainly that could be a step. Again, I just sort of return to what I think is, again, the single most important point, which is making those kinds of reforms, again, to get examiners focused on real core safety and soundness, really the core questions of what are the material risks to the financial integrity of firms, so that they don't necessarily get distracted by.
So you're saying we have to tell the Federal Reserve how to do its job. Is that what you're saying?
Well, it certainly could be the case. I would like to defer to the committee in terms of exactly how they want to go about that. But I do think, I would say this, I think the need is clear for, again, real structural reforms to the way that the Fed and the other banking agencies do supervision.
Let me move it along just quickly. The matters requiring attention and matters requiring immediate attention were the methods which the San Francisco Fed preferred in communicating with the SVP. Do either MRAs or MRIAs include teeth to enforce compliance, or are they usually more subjective?
I think it can vary depending on the precise MRA or MRIA. They tend to be somewhat formal, but they're not, for example, an enforcement action. They're typically included in exam reports or supervisory letters. And they're typically a predicate step where if over time the bank doesn't actually respond to those MRAs or MRAs, then more serious actions could occur.
Thank you. Mr. Clements, in the report released by GAO regarding the March 2023 bank failures, was any evidence found that could attribute any of these failures solely to past efforts to relax Dodd-Frank regulations on mid-sized and smaller banks?
Financial Services asked us to address that. We haven't gotten to the question of enhanced prudential standards in our report.
Okay, well, what discretionary authorities did those efforts permit Fed regulators to take regarding banks with $100 billion in annual assets like SVB?
In the case of SVB, it would still have been subject to a variety of prudential standards. At Category 4 institution, again, it moved up in level of supervision to the large and foreign bank organization, which increased the number of examiners, also increased some of the requirements for the bank.
Well, we know that SVP didn't have a person to occupy the role of chief risk officer for nearly 8 months. Should SVP's lack of a CRO raise red flags for regulators at the Feds? Should they have said, put somebody in that job and keep them there?
We're certainly aware that there was not a chief risk officer for a period of time.
And no, that didn't raise a red flag with anybody?
I'm not aware that there was an MRA related to that, but we can check.
Thank you, Madam Chair. I yield back.
Thank you, Ms. Fox. The chair now recognizes the gentlelady from Vermont, Ms. Bellin.
Thank you, Madam Chair. Good afternoon, all. Thank you so much for being here with us. When I listen to my constituents reflect on Silicon Valley Bank and its collapse, they really remember feeling worried not just about SVB, but really about their local banks, their community banks, and whether this contagion would affect them at the local level in Vermont. And I'm grateful that regulators took decisive action following the collapse of SVB. But I want Vermonters who have their money at local and community banks to understand the specific choices that were made by SVB executives that put their customers' money at risk. It will help them feel better about the situation that they're in back home. So I'm wondering, Ms. Judge, can you help us understand in layman's terms the risk that SVB was taking that led to its collapse?
Yeah, I mean, and I think it is incredibly important to distinguish the health and stability right now of small banking organizations, which have held up remarkably well and appropriately so during this period, and a bank like SVB, which more than doubled in size in an incredibly rapid and short period of time, did not institute the risk management that you need to handle that growth, and instead sought to search for yield by loading up on instruments that had very little credit risk, but lots of interest rate risk. And we saw as the Fed signaled that we were facing more inflation as it was happening globally at the time. They needed to tighten for purposes of promoting financial stability. They signaled this, and yet we didn't see SVB unloading those instruments or hedging appropriately. So what we saw was some very aggressive risk-taking, poor risk management practices, incredibly rapid growth, and reliant on flighty deposits as opposed to being focused on providing real services to real people.
Thank you. Appreciate that. Is it fair to say that they were gambling with their investors' money?
That is accurate.
Thank you, Ms. Judge. Mr. Clements, your report was critical of SVB's risk-taking. I'm wondering if you have anything additional to add to what Ms. Judge said about the risks that they were taking.
I think our findings were consistent with what she had mentioned. Again, long-dated securities funded through uninsured deposits.
Thank you, Mr. Clements. Ms. Judge, in your view, is it preferable to prevent this type of behavior, or it's better to clean it up after the fact?
Much, much better to prevent it.
Appreciate that. Ms. Judge, what actions should the San Francisco Fed have taken to address the many flags that arose at SVB in the lead up to its collapse?
The Fed did a decent job identifying some of the issues, but they failed to appreciate the magnitude of the issues. They weren't creative in appreciating the fragility that existed. And what you would have really wanted to see is an escalation framework in place in advance so that issues weren't addressed. They already had a plan in place for how they were going to escalate and then follow through on escalation. As the new team came in and the new team saw weaknesses that the previous supervisory team had not fully appreciated, to respond quickly, forcefully, and appropriately in light of the weaknesses they identified.
So the escalation framework or formula was not adequate.
I don't believe there was a structured escalation framework place. There was a general idea that once there were repeat problems, you escalate, but they had not committed to an escalation framework that really might have helped.
Okay. So one of the most important things that we can do within committee is obviously to figure out what went wrong and make sure we put whatever things in place that we can to prevent it going forward. So what do you think are the key takeaways that we should take from this hearing and from the lessons from SVB so that we can do our jobs and make sure this doesn't happen again?
The biggest one is appropriate regulation. If there's not appropriate regulation, banks are going to game the system that they have. You want to think about executive compensation, really trying to make sure that they can't walk away incredibly well compensated when a bank fails. And then you really want to make sure that supervisors are empowered and pushed to ask hard questions and to follow through with vigor. So you want to have bigger supervisory teams, you want to make sure they have adequate resources, and then you really want to make sure that they are asking the hard questions and are encouraged to ask the hard questions and to follow through with backbone and in a structured way when they see weaknesses.
So just to follow up on something you said, so tell me about executive compensation in light of what happened. Give me some idea of what went down and how it should have gone down.
Yeah, I think one of the keys is just introducing something. We already have some structures in place for clawbacks for banking organizations, but they should be more robust and they should be able to be used in a far broader set of circumstances, particularly in situations where banks fail, in situations like this where banks fail and have a huge hit to the deposit insurance fund. It's incredibly important both for purposes of incentives and fairness that the executive not walk away very well compensated while others bear such significant losses.
I really appreciate that. I yield back.
Thank you. The chair now recognizes Mr. Gosar for 5 minutes.
Thank you, Madam Chair. Excessive spending has consequences. Both Republican and Democratic administrations are guilty. However, the devastating effects of inflation caused by Uncle Sam not spending within his means has only now caught up with American people in the last few years. The reason? Trillions of dollars given to the public through stimulus checks, enhanced benefits, and forgiveness business loans during the COVID-19 response created an excess of dollars in the market, in a way that the previous zero interest rate era, where printed money just sat in the banks, does not resemble. But inflation is not the only evil that the fiat money system engenders. The downside of being world's reserve currency, and therefore the strongest currency, is that foreigners cannot afford goods priced in the strongest currency. And the reverse is true. Foreign goods priced in cheap currencies are easily affordable to Americans who wield the mighty dollar. That is why manufacturing flows to countries with weaker currencies like China, India, and Mexico. Goods are cheaper if they are sold to weak currencies. And who pays for this? Not the big banks, like Silicon Valley Bank, who are close to the money printing spigots, but the middle class working Americans whose jobs have been literally transplanted by China. That is why I'm a strong supporter of the Gold Standard Restoration Act introduced by Alex Mooney. It would solve the double problem of inflation and job offshoring. Going back to the gold standard would be the single biggest thing Congress could do to help the middle class in America. Now, questions for both you, Mr. Clements and Mr. Newell. Has the Fed's decision to raise its policy rate by 450 basis points between January 2022 and March of 2023 created a national banking crisis?
We hadn't done work to be able to justify that. Clearly, the increase in interest rates caused a decline in the value of the portfolio at Silicon Valley Bank.
That was you, Mr. Newell.
Yes, sir. I would say I'm a bank regulatory expert, not an expert in monetary policy or a financial analyst. I guess I would say, I think if you look across the banking system, I think the vast majority of banks have done an admirable job of managing interest rate risk. Obviously, Silicon Valley Bank did not, but I'm afraid that's the most insight I can offer you.
So now, why would anyone keep their money in a bank if they could make a return of 5.6% on 1 month treasuries? Mr. Clement, you answer that?
You know, I'd probably go with Mr. Newell. I'm not an expert on.
But I mean, 6% is a pretty good yield, isn't it?
It's better than what you can get on a typical bank account.
Mr. Newell, do you have any answers?
Apologies, I confess I did not come prepared to provide a full assessment of the merits of treasuries relative to bank deposits. I would say that bank deposits have a variety of other advantages, including transactional capabilities and so on, but I'm afraid other than that, I can't offer any real insights for you.
So would you say that the Fed acted recklessly by this action? Yes or no, Mr. Clement?
I'm just not qualified to discuss that.
I guess, Mr. Newell, you're not qualified either. How about you, Ms. Judge?
I think the Fed was pursuing price stability, which is an important mandate, and I think banks have the obligation and should be able to, as most banks have, to be able to handle changes in the interest rate environment as a result of inflation that is global at the moment.
Yeah. Now, granted, the committee has uncovered concerning practices by Silicon Valley Bank, but I'm afraid that the problem is deeper than the simple mismanagement of just one or a couple particular banks. It's the Federal Reserve's unprecedented tightening in response to unprecedented COVID-19 response spending that has caused a stock, bond, and overall banking crisis. Would you agree with that, Mr. Clements? Yes or no?
Again, I'm not qualified to discuss that.
Pay grade? How about you? Yes or no, Mr. Newell?
Again, I don't think I have the expertise.
Above your pay grade? Ms. Judge, you seem to have a pay grade.
Qualified or not, I mean, the Fed has a number of different mandates. Core of those is managing to control inflation. I think they are prioritizing that. That does put a pressure on bank regulators and financial regulation for promoting stability.
I hear you. I got one thing. In a recent Senate hearing, Janet Yellen said the quiet part out loud. Systemically important banks, AKA big ones with political connections, will always be bailed out by the government, but not smaller community banks. Yes, investors will lose their money in most cases, like those who invested in Silicon Valley Bank, but the depositors will always be safe. Is having bailouts for the big guys but not the small guys a fair policy? No, it shouldn't be. But we've already set the precedent now. Does it make banks less likely or more likely to engage in risky behavior, knowing that the depositors will never lose any money? Hell yes. Is this why community banks are disappearing? People know Big Brother will swoop in and only save the big guys, but leave the little guys all alone. There's something more to this story, and the American public needs to be protected. I yield back.
Thank you, Mr. Gosar. The chair now recognizes Ms. Lee for 5 minutes.
Thank you, Madam Chair. You know, sitting through this hearing, I can't help but wonder, where is the leadership of Silicon Valley Bank? Are we really going to let another corrupt and greedy financial executive sneak away unscathed, like in the aftermath of the 2008 financial crisis? My Republican colleagues seem to be blaming the government for this bank collapse, but you can't take away the teeth from the regulatory agency and then cry foul when it doesn't function properly. We do remember that President Trump, along with a Republican-controlled Congress, gutted Dodd-Frank's financial stability protection rules. No? Quick recap. In 2018, the Trump administration signed into law the Economic Growth, Regulatory Relief, and Consumer Protection Act, rolling back key Dodd-Frank reforms designed to protect Americans from a financial crisis like in 2008. In 2019, President Trump's regulators issued rules that further undercut Dodd-Frank's protective standards. These same Trump-era reforms relaxed requirements for banks under a certain size, allowing risk to run rampant at mid-sized banks like Silicon Valley Bank. Ms. Judge, how did the Trump-era rollbacks of these critical Dodd-Frank provisions create an opportunity for excessive risk-taking at SVB?
One of the greatest ways that they did that was by facilitating growth. Prior to that, you paid significant costs in terms of heightened regulatory standards. As you grew, we saw that they managed to grow incredibly rapidly. They were subject to modestly enhanced standards, but that was at an incredibly slow rate, so that enabled rapid growth, inadequate attention to both the credit risks and the liquidity risks associated with that growth.
Thank you. The Trump administration gutted the oversight of mid-sized banks, encouraging that rapid, reckless business practices. Under Dodd-Frank, banks with more than $50 billion in assets were subject to enhanced standards to ensure financial stability. Under Trump, the threshold skyrocketed to $250 billion in assets, leaving mid-sized banks room to play fast and loose with people's money and prioritize their own profits. In 2015, Greg Becker, CEO of SVB, testified to the Senate Banking Committee to urge increasing the threshold. Becker, I apologize for the mispronunciation of name, emphasized that mid-sized banks like Silicon Valley Bank don't present systemic risk. He then reaped the rewards of those relaxed regulations. He took risks with people's funds and prioritized his personal bottom line while leading his bank towards collapse, threatening our entire financial system in the process. Ms. Judge, what are the most important safeguards to ensure that the interests of banks and bankers are aligned with the interests of the public?
I think we know a lot of the tool set, and a lot of it was the tool set that was previously in place. We need to have the full set of prudential requirements, enhanced prudential requirements, applicable to all large regional banks. We need to be honest about the fact that any bank with more than $100 billion of assets is a very large bank, and that we now know unanimous, both Republican and Democratic, members of the FDIC board and the Federal Reserve Board of Governors recognize that they pose a potential threat to stability. I also think we need to go forward and figure out how to strengthen stress tests and otherwise make sure that there is ongoing diligence with respect to the regulatory standards and the supervision of these institutions.
Could you describe how the collapse of mid-sized banks such as Silicon Valley Bank can destabilize the entire sector?
One of the things that I think was actually unexpected for most of us was the destabilization risk, and yet it was nonetheless broadly recognized. And I think largely it's through both contagion, the possibility of failure of one bank creating fears at other banks, particularly because these were, as was previously noted, the 16th largest and 29th largest banks at the time they failed. So you're talking about incredibly large banks. They also both had incredible numbers of uninsured depositors. And once you have depositors potentially losing money, you create fear. The banking system is dependent on trust.
Thank you. Really quickly, and Mr. Clements submitted testimony for today's hearing. He stated, and I quote, from December 2018 to December 2022, SVB's total assets more than tripled from $56 billion to $209 billion. Mr. Clements, is it correct that despite this rapid growth, the bank still did not meet the new higher threshold for heightened oversight?
The prudential standards had been reduced, so the standards that would apply to a Category 4 firm would have certainly been less than for higher level firms.
So as a result, Silicon Valley Bank avoided much of the rigorous stress testing that would have been required under Dodd-Frank rules. Ms. Judge, is it likely that earlier stress testing would have flagged some of the warning signs that the bank was headed towards collapse? Really quickly, because I'm running out of time.
It's hard to know, but more rigorous stress testing would have potentially revealed the weaknesses in their ability to foresee how they would fare under adverse circumstances.
Thank you. SVB aggressively and successfully lobbied for loosening of Dodd-Frank. The bank then took advantage of the new lax environment to engage in excessive risk-taking, which did nothing but pad the pockets of greedy execs. If we're going to conduct meaningful oversight over what happened at SVB, we need to bring the bank's leadership in for questioning, as other committees have. Thank you to the panel, and I yield back.
Thank you. The chair now recognizes Mr. Grothman for 5 minutes.
Thank you. I'm old enough to remember like the 2006 housing bubble. And I think it's always important for those of us who have control or not direct regulatory authority over America's business to remember that it's their property, not our property, and we shouldn't be abusing our position to self-righteously have fun at other people's expenses. I had thought of that because the housing bubble was caused by the leadership class or the government class weighing in on businesses and encouraging banks and other financial institutions to make loans that they never would have made normally. And a lot of people, lost a lot of money, lost their jobs because people felt it was their business to, like I said, self-righteously tell financial institutions to make loans they wouldn't have normally made that resulted in that crisis. We have some of the same type of feeling going out now in which the government is kind of weighing in to say it should make it easier for people to get loans who maybe will have a hard time paying them off. But we'll start with Mr. Newell today. In your opinion, when I see Mary Daly, the head of the San Francisco Fed, and Greg Becker, the head of Silicon Bank, they both seem the type of people who maybe are bored with banking and bored with making money and like to take other people's money and play around with equity or play around with climate initiatives. In your opinion, has leadership of the San Francisco Fed focused too much of its resources on these issues, maybe too much of their time on ESG or equity and inclusion initiatives? And if so, does this focus distract the exam team and bank management from what should be their primary goal, safety and soundness?
Thank you, Congressman. I think I would start by noting, as I did in my testimony, it does seem the case that one of the core problems in supervision of SBV is that supervisors weren't appropriately focused on the real material risk to the safety and soundness of SVB. And so I think understanding exactly why that was the case is very, very important. As to your specific question, I think it's hard to say at this point exactly what they were distracted by. We don't have from the Fed report a clear picture of what all the supervisory priorities were at the Federal Reserve Board, at the San Francisco Fed, at the exam team itself. And so I actually think one of the important things here is gathering a much more complete picture so that we can fill in those blanks. And we know that their attention wasn't on identifying all the right issues, but I don't think we have a full picture in terms of why that was the case and all the things that were necessarily distracting.
I think it must be a psychological thing, and I think I can guess. Socially, it's more fun to say at the cocktail party, at my job at the bank, I'm dealing with global warming, I'm dealing with racial equity. It's more fun than saying, I'm just doing what bankers should do and maintaining a sound bank here. But in any event, San Francisco Fed Chief Mary Daly openly touted her efforts to spearhead left-wing initiatives and ESG policies through her work. Do you think, and she was certainly a champion of this sort of thing among the Fed chiefs, do you think these initiatives may have distracted the Fed itself from what should be its overarching mission?
Again, Congressman, I think, unfortunately, it's hard to just give a definitive answer to that question just because we don't have a complete picture, again, of where the supervisors were focused and what may have been distracting them. Again, I do think it's clear that they weren't appropriately focused on the core material risk to SBV's financial integrity, but I don't think we have a full picture of what the drivers of that were necessarily.
What is, I know this Greg Becker here guy, he was focused on combating racial inequities. What does he do? What does that do? I mean, you took pride in it. How does he run your bank differently if you want to focus on racial inequities?
My apologies, Congressman. I'm not sure I can speak to that question or what he may or may not have had in mind.
Why don't the other two of you know what you would be doing differently if that was one of your focuses?
We focused on the liquidity and risk management, not the other aspects of the Fed supervision, so I can't really comment on that.
Okay, you must have been doing something different. Okay, next thing, as far as climate change, do you know what you would be doing if you were heading a bank and focusing on climate change, which you seemed to think was important as well? Do you have any idea? Can you give me another, I'll ask another question, because obviously we got to focus on this Mr. Becker character. How much money was he making a year, do you know? No idea. Okay, any idea what any of the management team over there was making?
We know it went up over 30% just in the last couple of years, and it was in excess, I believe, of at least $1 million, I think potentially more. It's in my written testimony, but they were quite well compensated, and their compensation grew as the bank grew.
Like what? You can guess wildly? No. I think it's something that's interesting for society. But in any event, thanks for giving me another half minute.
Thank you. The chair now recognizes Ms. Crockett from Texas for 5 minutes.
Thank you, Madam Chair. The irony of today's hearings isn't lost on me. A key talking point of my Republican colleagues has always been heavy deregulation and significantly less oversight of banks without proper safeguards in place. It seems, however, that my Republican colleagues have now seen the light, and I'm excited about this. Nevertheless, today's hearing lets us have an important and necessary conversation on oversight and the role of regional and small banks in our communities. Arguably, the most important responsibility of the Fed is the ensuring of the financial stability of our banks and upholding consumer confidence in the system. When SVB crashed, it left customers at our banks worried about their money. Herein lies the problem. Failing to oversee the actions of one bank led to an avalanche of people wanting to pull their money out of other banks. What is the result? A catastrophic effect on small and regional banks. Many people don't think about small regional banks like Comerica and Amegy in my district and the vital role they play in our communities. These banks provide locally informed investments that enable small businesses and startups to thrive in a challenging economy. Amegy, for example, has 2,764 small business customers in the Dallas area alone. They provide loans and services to groups that have been historically overlooked. For instance, Comerica provided a $1 million investment in the Dallas Small Business Diversity Fund that supports women and minority-owned businesses in Dallas County. Blaming SVB's collapse on environmental, social, governance, investing, or diversity, equity, and inclusion initiatives is nonsense. To quote experts from Harvard Business School, not exactly a liberal bastion, blaming ESG of DEI or SVB's failure reflects either, quote, a complete lack of understanding of how banks work or the intentional misattribution of the cause of the bank's failure. My Republican colleagues' continued focus on wokeness in banking also suggests that they see improving economic opportunities for people of color and investing in minority-owned businesses as a bad thing, and that's truly a shame. I ask unanimous consent to introduce a New York Times article titled, "No Wokeness Did Not Cause Silicon Valley Bank's Collapse," and with that,
Without objection.
thank you so much. Now, I'd like to ask, small businesses and everyday folk need to trust that their local bank is making smart investment choices that are in their business interest. So when something like SVB happens, even if it is a different bank entity, and even if it is in a different state, that has enormous ripple effects. And to be honest, the first thing that I did the next day, the next business day after the collapse, was check to see what the numbers look like for the banks in my area, because I have a large banking industry. In fact, the regional Fed is located in my district in Dallas County. And guess what? I saw a 25% drop in the stock of Comerica alone that first Monday when they opened, even though they had nothing to do with SVB. So with that, Ms. Judge, how can the Fed work to restore and build up consumer confidence in regional and small banks, given the reputational damage they have received from SVB?
I think it's one of the most important things that they should be focused on. One of the things that's actually been really comforting is that community banks, those with less than $10 billion in assets, have come through remarkably well. New research from the New York Fed shows that they really haven't lost any deposits, despite the interest rate and despite the recent fears. For regional banks, I think it has to mean appropriate regulation. I think we didn't just have one regional bank fail. We had 4 regional bank fails. 3 of them failed in ways that resulted in significant losses to Deposit Insurance Fund. 2 required the systemic risk exception. So I think knowing that they are appropriately regulated is the key first step to rebuilding that trust.
Thank you so much. Now, the final part of this is where I'm gonna get a little spicy here. I can't help but to sit here and be frustrated because we are saying that we're concerned about SVB and what banks are doing and what they're not doing. But the big elephant in the room is the fact that we have this debt ceiling issue that is looming over our heads right now. And somehow, Democrats, I wasn't here, but what I hear happened when Trump was president is that Democrats agreed to raise the debt ceiling 3 times under his leadership, 3 times. In my mind, I feel like that may be a record number of times. I am curious to know, how is it, if it will, affect banking if we fail to pass a clean debt ceiling limit? Are we concerned that banks may end up suffering failing if we fail to do our jobs in Congress? Anybody? It's because I ran it. Nobody went. Okay, I'm gonna just tell y'all the answer. The answer is yes. And so we need to focus on our work here in Congress. Right now, we need to pass a clean debt ceiling if we really care about the stability of banking in this country and Americans. Thank you so much for being here.
Thank you, Ms. Crockett. The chair now recognizes Mr. Fry for 5 minutes.
Thank you, Madam Chair. And just as a short aside, I think it's important to note that the American people spoke very clearly in the last election about cutting spending in Washington. According to a CNN poll recently, 60% of Americans want a debt ceiling increase paired with cutting spending. To my colleague, thank you to our witnesses for being here today. I believe that the collapse of SVB and others can in part be attributed to a lack of confidence in our financial system. These 3 banks all exhibited serious faults in oversight, senior management, and risk management. Certainly these banks were outliers in the broader banking landscape as they catered primarily to wealthy clients and startups and had unusually high percentages of uninsured deposits, 94% to be exact. But in the backdrop of all the cast and characters of these failures, rising inflation rates and exuberant spending have an obvious role to play as well. From the government side, just like every other bank, SVB and others were caught in the whirlwind of an ever-increasing government spending and the Fed's battle with interest rates and rising inflation. The sheer amount of money that was pumped into the U.S. economy since 2020 allowed for many banks to bolster their investments and focus them on loans, technology, new branches, and other assets. SVB, for an example, included in its strategy the massive acquisition of government bonds with longer times of maturity. You talked about this in your testimony. Normally, a bank keeps enough cash on hand for the everyday ebbs and flows of incoming and outgoing deposits, but it is important to highlight that any bank would have tremendous difficulty withstanding a run on deposits the way that these banks experienced. With that, I want to start out with just kind of a premise question. You talked about this. What forces within the bank, with management, contributed to SVB's failures? Mr. Clements, I'll start with you.
The challenges we saw were with liquidity and risk management, again, from the documents, from the San Francisco Fed documents, that there were weak liquidity, weak risk management. There were attempts by the bank to resolve the challenges, but they were not successful.
Mr. Newell, anything to add to that, sir?
Yeah, I think maybe what I just underscore again, I think when you try to diagnose what went wrong at SVB, first and foremost, it's a function of the interest rate risk they took. They had a large portfolio of government securities that, as folks have noted, are very low credit risk, but had very high interest rate risk, and therefore were exposed to serious losses once interest rates increase rapidly. And then once those losses did occur, undermined public confidence in the bank, and then very quickly led to a run on the bank, which was difficult to stem given the overwhelming reliance on uninsured deposits at the bank. So I think it's really the combination of those 2 factors, first and foremost, that was the case here.
Right. What forces outside the bank's control, right? So macro forces, regulatory forces contributed to their demise. Mr. Clements?
Mr. Newell noted the rising interest rates had a negative implication for the portfolio. SVB didn't hedge that. Interest rates have gone up for all banks. Most banks haven't failed. SVB did not adequately hedge those risks that it was facing.
Right, and looking at this, we've heard a lot from the other side that there was no regulations, that people could not oversee what was going on, but the Fed did have the ability to look under the hood, so to speak, of SVB, did they not?
The supervisory team, once SVB moved to the large and foreign banking organization, was approximately 20 individuals. We certainly saw matters requiring attention. Regulators were aware of the problem. Our point is that they did not escalate, perhaps to either an informal or formal enforcement action in time to address the problems.
Would you offer the same answer, sir?
Yeah, I mean, I think the thing that I would particularly underscore, again, in terms of what the regulators' tools were, because there's been a lot of debate in terms of what the rules were or might have been changed. Most importantly, we've had in our U.S. banking law since 1966, I believe, a core prohibition on engaging in unsafe and unsound practices, along with a corresponding authority of the regulators to order banks to cease and desist from unsafe and unsound practices. I think if you just look at the simple facts and the interest rate risks that accrued at SVB's balance sheet, I think in retrospect it certainly looks to everyone like an unsafe and unsound practice. So I think it's unquestionably true that they had that long-standing authority and could have acted, but just isn't in the record.
Mr. Clements, just real quickly, obviously there were MRAs and others that were kind of flagged toward the bank. They were given to the bank. At what pace do regulators receive financial monitoring information from banks?
It'll vary by the size of the institution.
And beyond that, is there anything that can be done? Madam Chair, with that, I look like I'm out of time, but I yield back.
Thank you, Mr. Fry. The chair now recognizes Mr. Burleson for 5 minutes.
Thank you, Madam Chair. We all kind of now know, after the fact, what the reasons for the bank's failures are. It's pretty easy to do Monday morning quarterbacking, right? But my question to you, Mr. Clements, is are there similarities between the failures of Silicon Valley and what happened at Signature Bank and at First Republic Bank?
We looked at detail at both SVB and Signature Bank. I think the problems were similar. In both instances, the regulators identified challenges, had MRIAs, MRAs, MRBAs in the case of FDIC at Signature Bank. The concern was just the escalation when problems were not being resolved. Once a serious risk was identified, not taking enforcement action on a timely and forceful enough manner.
Outside of those banks mentioned, how often do banks fail in the United States?
It's quite infrequent.
Quite infrequent, but it does happen.
Within prior, post-financial crisis, it happens occasionally.
And in those times, were the individual bank holders, were they paid above the $250,000 limit? Were they insured beyond that? Did the Fed insure them beyond?
We haven't done work to look at all those bank failures. In many instances, the FDIC will resolve an institution through a purchase and assumption, and in that instance, the deposits will simply move to the new institution.
Okay. So this is, I don't know if you can answer this question. What message do you think this sends, the actions of the Fed sends to the small banks across America who pay these fees so that their clients are insured? What message does, what the events that happen, what does that send?
I believe in the instance of SVB and Signature failure, there was a systemic risk exception. So FDIC needs to collect those funds through a special assessment. We haven't looked at the methodology that that the FDIC is using to gather that special assessment. It does have the ability to target it to the the institutions that would benefit from the systemic risk exception.
Thank you. Mr. Newell, during the Fed's postmortem report, it considered all the relevant factors. They tried to include everything. Was there anything that they didn't consider that they should have been including?
I think if you look across the Fed report, again, consistent with my comments to start, I don't think they really appropriately consider the extent to which examiners focus on processes and governance and issues that didn't really go to the sort of the core material risk to SVB's financial integrity that were the problem here. I don't think there's a real assessment of the extent to which they were focused in the wrong place. Again, I think if you look across the Fed report, because it's the information we have at this point in the exam materials, it pretty consistently points out, to me at least, that generally speaking, they were not identifying the real problems. They were principally focused on other things. And so I think that's certainly an area that...
And what were those other things they were primarily focused on?
Well, again, I think if you look at the 31 MRAs that existed when SVB failed, that's a good example. Again, only 7 of those had anything to do with the liquidity or interest rate risks that really that led to SVB's failure. They were otherwise focused on information technology. I think there's some BSA/AML, vendor risk management, trust management. Again, which is not to say these are areas that are unimportant, but certainly relative to what we now know were very clear interest rate and liquidity risks, certainly second order questions. So again, I think one of the gaps in the Fed report is the failure to really consider the extent to which that distraction from core safety and soundness in terms of the supervisory activities was part of the problem.
Okay, thank you. I yield back.
Thank you. I now recognize myself for 5 minutes. There seems to be a lot of blame and back and forth, the blame game going about what prevented the Fed from doing their job. The Federal Reserve's autopsy lays a lot of blame at Congress's feet because of changes that were enacted to Dodd-Frank in 2018. Mr. Newell, can you help me understand what tools the 2018 law actually took away from the Fed?
Sure, I'd be happy to do that. Particularly because I think there's been a lot of talk about these enhanced credential standards that were adjusted in the 2018 law, sort of a monolithic animal, when in fact it's a toolkit. And the best way to talk about that maybe is to talk about what changed in the aftermath of the 2018 law and what didn't.
But were there any specific tools that said, if you're under 250, you can't do X?
No, absolutely
Okay.
not. In fact,
the
2155 was extraordinarily clear in terms of granting the Fed with
In
wide
fact,
discretion.
am I to understand it correctly that it moved it from 250, but at 250, it was mandated that you do X, but if you were from 100 to 250, you still had all of the tools in your tool belt, and it was up to you, the regulator, depending on what the report, which from the report I saw was like a lot, could have still used those same tools. The regulators just chose not to do it. So we technically didn't take away any tools. Am I understanding that correctly?
Yeah, that's exactly right.
Okay. Thank you. Let me just go on. Are there other tools available to the examiners that would have allowed them to see this train wreck coming? So were there other tools that they could have used?
Certainly, I would maybe just start by pointing to 2. So first, one of the enhanced credential standards that was left in place after the 2018 and 2019 changes, it was a requirement that banks like SVB conduct internal liquidity stress tests. And on the basis of the results of those tests, hold a sufficient buffer of liquid assets to survive a 30-day period of stress. As it turns out, and the Fed report's quite clear, in 2022, SVB was running those tests, and they were failing those tests. And sort of one of the...
What'd the regulators do?
The regulators, again, none of the 31 MRAs or MRIAs cite SVB for a violation of, again, that actual hard-coded requirement under Regulation YY. And in fact, the Fed explains the reason that they didn't do that is because they were more focused on the MRAs they had issued the prior year that were focused on sort of processes and procedures.
So on
policies.
top of, right? Because I'm in agreement with you on SVB Bank has a lot of ownership right? And I think, Ms. Judge, you even said we need to hold executives accountable and they need to not be able to walk away. I'm actually the weird one that thinks we should actually hold the regulators and the government agencies to the same standards that we hold the businesses to. Yet, my God, we can't talk about that. And that, I think, lies the frustration. The regulators had the same tools, they just chose not to use them and hide behind the Dodd-Frank rule, right? How about we just do the job that you're getting paid to do? So I have one more question. A simple reading of the Barr report implies federal examiners felt the former head of supervision wanted them to go lightly on the banks they were charged to oversee. We don't have access to the evidence that supposedly supports this assertion. So, Mr. Newell, is it your opinion that the Fed examiners are hindered from the former vice chair's alleged lax regulatory oversight culture?
Yes, so you point to a very interesting and curious part of the Fed report. It certainly makes that assertion. It doesn't really support any evidence for that assertion other than, I think, interview notes with some of the staff involved. I think it's one of the things that absolutely merits looking into further and is sort of one of the places where there are gaps in the Fed report that could be filled. But again, I personally think it's very unlikely that some unwritten sort of supervisory vibe for a more lax environment was ultimately the downfall. I think there certainly are unexplained delays and inactions over the supervisory timeline. My suspicion is if one were to further investigate and do more digging, there are probably alternative, more plausible explanations in terms of dysfunctions within the Federal Reserve System.
I appreciate that. I'm running out of time. Mr. Clements, I will direct my same question to you. Have you observed that the Fed examiners are hindered by the former chair's allegedly lax regulatory oversight culture?
We had a single meeting with the Federal Reserve. The issue of culture didn't come up.
Interesting. With that, the chair now recognizes Ms. Porter for 5 minutes.
I'm going to read from the Federal Reserve's report. It says that SVB-FG became subject to liquidity risk management and internal liquidity stress testing requirements that apply to Category 4 firms starting in the third quarter of 2022. But before that, before the third quarter of 2022 is where the problem really got cooking, right? By the time we were into the third and fourth quarter, and then they have time that they have to comply with these requirements, by then the bank has failed. So I want to step back and read from earlier. It says, and I'm quoting from the Federal Reserve's report, the changes due to EGRR-CPA, which I will call S2155, the deregulation of Dodd-Frank, the 2019 tailoring rule, which was promulgated by the Federal Reserve. They claim that Congress, quote, made them do it, but that was up to them, and related rulemakings, which to be clear were also the Fed's decisions, had a significant impact on the level of requirements to which SVBG was subject in 2018 and beyond. Had these changes not been made to the framework, SVB-FG would have been subject to enhanced liquidity risk management requirements, full standardized liquidity requirements, like LCR, enhanced capital requirements, company-run stress testing, supervisory stress testing at an earlier date, and tailored resolution planning requirements. There is, in fact, in this report, an entire table, Table 12, which I would like to introduce into the record, Madam Chair, that lists all of the requirements that they used to be subject to, would have been subject to, and then were now no longer subject to. So it seems to me, while there's no doubt that the Federal Reserve may not have used the tools in the toolkit, it's true that they just made very clear to the SVB may not have used all the tools. The Fed told them that they didn't need to. The Fed told them you don't need to look at your LCR, that a 70% is good enough. You don't need to get to 100. So my question is, Mr. Clements, why does the Federal Reserve not bear responsibility for creating requirements that led to the bank's failure? I mean, SVB would not have met the LCR ratio. Point blank.
Yeah, at this point, we haven't looked at the enhanced prudential standards. Again, what I would suggest is that there were problems at the bank with the internal liquidity stress testing, that a trigger mechanism would have forced action much quicker.
Mr. Newell?
Certainly. So maybe let's take a couple of those items each in turn. Because I just disagree with the conclusion in the Fed report that these changes of enhanced prudential standards made a huge difference in the case of SVB. So first, throughout the process, SVB was subject to the requirement that it conduct internal liquidity stress tests, which again in 2022, it was not in compliance with. So this was a clear enhanced prudential standard.
Mr. Newell, reclaiming my time, the Federal Reserve Board's own report says that they were not subject to the internal liquidity test. Are you saying the Fed's wrong about the regulation?
Yeah, I don't believe that's the case. I'm reasonably certain that they were subject.
I mean, I'm going to read you from Table 12. Silicon Valley Bank's requirements as a Category 4 firm as of March 1, 2023. Bullet point, no company-run stress testing requirement.
Yes, so that refers to the capital stress testing exercise. It's very different than the internal liquidity stress.
Great, so let's take liquidity. No LCR requirement.
Yes, so that's right. Again, I think you have to look at the enhanced prudential standards under 165 in their totality. There was a liquidity requirement that applied to SVB. Both
It was 70%.
No, I'm actually not talking about the LCR. This is an internal liquidity stress testing requirement that requires the bank to run the test, and after the test to hold a sufficient buffer of liquid assets to survive a 30-day period of stress.
So did SVB do that?
They were subject to the requirement. They did that. The results showed that they did not have enough liquidity. So here we have directly on point an enhanced prudential standard that was left in place about liquidity that SVB remained subject to, didn't comply with, and the supervisors didn't act.
Okay, so I just want to wrap up. So the rules were lousy, the regulators were lousy at enforcing them, and the banks didn't step up and take care of it all by themselves. That seems like the takeaway. I don't think it's a choice between these things. I think all three of these things seem true. I yield back.
Thank you, Ms. Porter. The chair now recognizes Mr. Fry for 5 minutes.
Thank you, Madam Chair. Round two, we're back at it again. Mr. Newell, I was on this subject before. I ran out of time before, but we were talking about liquidity risk and the fact that regulators were not aware until 2 days prior the bank ultimately failing. At what pace do regulators receive financial monitoring information from banks?
Of course, thank you, Congressman. That varies quite widely, depending on the size of the bank and the particular bank involved. Certainly with larger banks, there are, quarterly reports, monthly reports, in some cases, daily reports. I think I'd have to dig in to give you a precise answer in terms of exactly what the cadence of information was in the case of SVB. In addition to that, for a large bank like SVB that was subject to what they call continuous monitoring, which is a dedicated exam team always on the case, there are kind of routinely back and flow requests for information. So there typically is a very steady cadence of information and certainly a lot of ability for examiners on an ad hoc basis to request more information.
Would the existing regulatory framework benefit from real-time monitoring of these issues?
Certainly more information and data is always better. I think to give you a fair answer, I need to think about it a little bit more. I'm happy to do that and work with your office and get back to you. But certainly, more real-time information is better, all things equal.
What actions can regulators take if they identify deficiencies or noncompliance in bank operations?
Certainly, so they have a very broad toolkit, and it sort of runs a spectrum of less informal activities to all the way to sort of formal enforcement orders. At one end of the spectrum, you have sort of just informal conversations. Again, exam teams talk with banks all the time. raise issues into conversation all the time. When there's a more serious issue, there's typically an issuance of an MRA or MRIA, which is a sort of examiner directive saying you need to fix the following problem by the following date. And then when concerns are more serious or where there are MRAs or MRIAs that haven't been addressed for a long period of time, there's a whole suite of various types of enforcement actions and similar orders that regulators can take to demand action.
Thank you. Mr. Clements, in the GAO report that you were talking about earlier from March 2023 related to the bank failure, in the review, did you find that regulators failed to escalate supervisory actions at their disposal in time to mitigate SVB's failure?
That's correct. We've certainly found that they identified problems, but given the severity and long-term nature of the problems, we did not think the escalation was adequate.
Throughout the years, has GAO observed a pattern of issues in supervisory action?
This pattern goes back to the savings and loan crisis in '91 of the supervisors are good at identifying problems. There appears to be a problem of using the full suite of tools, and especially the most forceful tools available to them.
Thank you. And finally, does FDIC have the proper early warning systems in place to detect high rates of uninsured deposits?
That I'm not sure. I would need to get back with you on that.
Mr. Newell, are you aware of that at all?
I'm not sure about early warning system, but certainly I think the FDIC has access to lots and lots of data in terms of what the composition of the deposit base at insured banks is, and to what extent those are insured or not insured. I think those are part of the typical call reports.
Thank you, Madam Chair, and with that, I yield back.
Thank you, Mr. Fry. The chair now recognizes Ranking Member Porter for her closing statement.
Thank you, Madam Chairwoman, for addressing recent bank failures in this subcommittee. This is an incredibly important topic, and I wish I could say that this was my first rodeo with bank failures, but it is actually my third. I hope you won't take it personally, Madam Chairwoman, when I say that I'm tired of talking about what can be done to stop bank failures. Back in 2018, when I was first running for Congress, I publicly warned my future congressional colleagues not to pass S-2155, a bill that rolled back Dodd-Frank regulations. I knew that deregulation would set our country up for bank failure, and Republicans and too many Democrats didn't listen. When I got to Congress in 2019, I pushed Mr. Powell from the dais to not reduce the regulatory standards, reduce the testing, and he assured me that, in fact, there was no such reduction in regulatory tests. Now here I am in my third term in Congress, and we've had a string of bank failures, all starting with Silicon Valley Bank. The Fed has affirmed one of the main contributing factors to this failure was the lower supervisory standards that came from passing S-1255, their 2019 tailoring rule, and their related rulemakings. Surprise, surprise. We regulated after the 2008 financial crisis. We deregulated with bipartisan support under President Trump, and now we're back at bank failure. What's even worse is that we have too many members in both parties who claim we don't know what to do to break this vicious cycle. I'm glad and grateful that there has been bipartisan agreement that bank supervisors need to do a better job. I might even say, do their job. That's clear. Bank regulators needed to better manage Silicon Valley Bank's vulnerability and hold their management accountable more quickly. In the future, bank regulators need to be more active supervisors for all banks under their purview. But effective supervision requires both good regulators and good regulations. We don't have the right regulations. First, let's roll back the worst part of the bank lobbyist bill that Congress passed in 2018. Title IV of that law raised the asset threshold at which a bank is considered and regulated as a systemically important financial institution, exempting Silicon Valley Bank and other similarly sized banks from enhanced liquidity and other requirements. Because of the loosened restrictions, when push came to shove, Silicon Valley Bank hadn't kept enough liquid assets to pay out the dollars being drawn out. If Dodd-Frank had been kept intact for banks of this size, Silicon Valley Bank wouldn't have had the choice to choose to prioritize its profits over stability. I don't want to give banks this choice again. I urge all of my colleagues to co-sponsor my Secure Viable Banking, SVB Act, and to roll back Title IV of S2155. Second, let's stop bank executives from unjustly earning millions in stock sales and bonuses while they mismanage their banks into failure. That's exactly what my bipartisan Failed Bank Executives Clawback Act would do. Again, it's bipartisan, folks. I've got Representative Spartz, Gallego, Buck, Glusenkamp, Perez leading this bill with me. I think everyone here can identify with at least one of those members. This bill is something we can do now across party lines. Oversight is my bread and butter. It's important to hold regulators to account, and I'm grateful for the chairwoman's partnership in that regard. But unless we can take what we learn from oversight and translate it into effective policy, regulations will continue to swing with the political tides. Let's put regulations and regulators in place that keep our economy growing and stable. I yield back.
Thank you, Ranking Member Porter. I now recognize myself for a closing statement. Thank you all for being here. Thank you for your testimony. Today's hearing was very helpful in the first step in understanding the many failures that led to Silicon Valley's bank's collapse. The executives and the board at Silicon Valley Bank clearly dropped the ball. I haven't heard anyone argue that difference. Their incompetence has not been questioned, and the markets have held them accountable. But yet again, federal bureaucrats fail at their jobs and escape any accountability. What is their consequence to their action? The fact that there have not been any resignations or any firings at the top of the Fed and the FDIC is unfortunate, but it's not surprising for this administration. I mean, not a single resignation or firing or reprimand. I mean, SVB was what, number 19? And no one's head's gonna roll? Really? Tell me how that would play out in the private sector. It doesn't. The lack of self-awareness or accountability knows no bounds with this crew. But we were sent to Congress to hold people accountable, especially on this committee. And that's what we are going to do through our investigations, our future hearings, and our future legislation. In closing, I want to thank our panelists once again for their important testimony today. And without objections, the members will have 5 legislative days to submit materials and submit additional written questions for the witnesses, which will be forwarded to the witnesses for their response. If there is no further business without the objection, the subcommittee stands adjourned.